If you dream of being able to live off dividends much sooner in your life, you're obviously going to need to put together a diversified portfolio of higher income producing holdings in order to achieve that goal. While dividend stocks offer investors regular quarterly payouts, there are other investment options out there that'll earn you considerably more income. And what's great is that all of these investments trade on stock exchanges, just like stocks and ETFs, which makes it more convenient. But maybe you're not too familiar with what types of holdings offer higher dividends, or maybe you've heard of investments like REITs, MLPs, CEFs, but you don't exactly know how they work. In today's video, I'm going to be introducing some of the various type of investments out there that pay investors much larger dividends than your typical dividend growth stocks. I'll describe how each type of investment functions, how it's able to pay such higher dividends, and then I'll also give some investment examples for each type. Before I get started, if you're interested in higher dividend paying investments, please consider clicking the like button below and also subscribing to the channel for more aggressive dividend investing strategy videos. I'm also now on Instagram at dividend_bull if you'd like to stay up to date on there as well. So with that being said, let's get started. The first type of investment to include in your high dividend portfolio are real estate investment trusts, otherwise known as REITs. These are a staple among income investors, and they're probably the most well-known dividend-oriented investment type out there. REITs own, operate, or finance income-producing real estate by pooling the capital of numerous investors, and then they're required by law to pay 90% of their profits they receive back to shareholders in the form of dividends. When you buy shares of a REIT, you're actually buying a fraction of a pool of real estate properties or mortgages. That means you can technically buy one share of the cheapest REIT out there for as little as 12 cents and then impress your friends by telling them that you're a real estate investor. And the best part is you don't have to worry about the headache that comes with traditional real estate investing, such as financing, managing properties, finding tenants, paying complicated taxes, etc. There's a lot of different types of REITs out there that invest in different types of properties. So for example, there's REITs out there that specifically own apartments, which pass off the rent received from tenants back to shareholders. Then there's also hotel and leisure REITs that own resorts, casinos, and entertainment venues. There's retail REITs that own strip malls, drugstores, convenience stores, and shopping outlets. There's office REITs that own office buildings, industrial REITs that own distribution and logistics centers, and then there's also telecommunication REITs that own wireless and broadcast communication infrastructure, and the list goes on and on. There's currently 194 publicly traded REITs according to the National Association of Real Estate Investment Trusts as of the making of this video. Most REITs pay quarterly, while some do pay monthly dividends to shareholders. If you're specifically interested in REITs that pay dividends monthly, I actually made a video a few weeks ago in which I put together a list of every single monthly paying equity REIT out there. I would say that REITs have dividend yields typically between 2% on the low end and over 6% on the high end. Some of the most popular REITs out there would include Realty Income, which is probably the most well-known REIT. They primarily own shopping centers and convenience stores, and according to their website, they've increased their dividend for 94 consecutive quarters, and they do pay dividends monthly. Another popular REIT would be WP Carey, which owns a lot of safer, recession-proof properties like government buildings, self-storage centers, and business wholesale stores. Finally, another fan favorite would be Stag Industrial, which is another monthly paying REIT that owns distribution and logistics centers for Amazon, FedEx, and other really solid companies. Another popular type of investment are BDCs, or business development companies. These are companies that provide funding to small and medium-sized businesses who need capital in order to grow their businesses. So what happens is these small businesses are given money to grow, and in turn, they have to pay the BDC a certain amount of their profits as per whatever their agreement was with the BDC, and then once the business development company receives these profits from the companies they invest in, they're required by law to pay out a minimum of 90% of their earnings to shareholders in the form of dividends. So they actually function in a very similar fashion to real estate investment trusts, only instead of property, it's with businesses. But with that being said, BDCs are considered to be riskier investments than REITs because small businesses fail on a consistent basis. That's what makes it all the more important to find BDCs that are really solid. Even really good BDCs can provide investors with dividend yields anywhere from 5 to 11%. The largest business development company out there is Ares Capital, ticker symbol ARCC, which has a dividend yield of 8.37%, and they have over $7 billion in net assets. This company was founded in 2007, and they survived both the 2008 financial crisis as well as the pandemic, which really adds credibility to the safety of this BDC. Another really popular BDC is Main Street Capital. While it does have a lower dividend yield, it does pay monthly dividends, and it has some of the best long-term growth out of any BDC in the industry. Next, we have closed-end funds, or CEFs, which are another type of investment that are excellent for people seeking high income. CEFs actually look and function very similarly to ETFs, in which they hold a basket of diversified stocks and bonds, and they both trade on stock exchanges, so you can buy CEFs just like your typical ETF. But there are a few distinct differences between them that you should be aware of. Unlike ETFs, closed-end funds raise money through an IPO, and they're usually actively managed. Because of this, CEFs do charge higher fees than your typical ETF. However, most expense ratios are still reasonable when compared to the amount of dividends they typically pay. CEFs also have the freedom to make changes to their fund's portfolio as often as they want, even daily if they wanted to, which is something that ETFs don't have the freedom to do. By design, closed-end funds are built for high income. The reason being that also unlike ETFs, closed-end funds use leverage in order to give investors higher dividends. While this can be a risky strategy, there are plenty of CEFs out there that have solid track records. But using this leverage can really give investors much solid returns for a little more risk. It's not uncommon for CEFs to pay high dividend yields upwards of over 6%. Some out there even pay well over 10% and even 15%, although those can be significantly riskier. Like ETFs, there's a wide range of closed-ended funds that primarily hold specific types of investments. There's CEFs that hold technology companies, utilities, infrastructure, bank loans, and others, so there's plenty to choose from out there. Some examples of CEFs out there would include the Columbia Seligman Premium Technology Growth Fund. This CEF not only has a great dividend yield, but it also has a lot of growth. Its share price is currently up over 104% from this time 5 years ago. For a CEF, that's some pretty incredible price appreciation. Another CEF with solid dividends is the PIMCO Dynamic Fund, which has a higher dividend yield and pays monthly unlike the Columbia Fund, but it does have less capital appreciation of its share price. Next, we have covered call ETFs, which are something that I'm sure a lot of you are familiar with if you've watched my other videos on my channel before. I made a whole video on QYLD, which is probably the most popular covered call ETF out there. Not to mention, I covered them again in a video I made last week. So I won't go into too much detail in this video, but I will give you a brief overview. These ETFs follow a covered call investment strategy, where the fund buys a basket of stocks and then also sells call options that correspond to that basket of stocks. What happens then is these options are sold every month, and the option premiums are passed on to investors in the form of dividends. Because the options are sold every month, these funds don't benefit nearly as much from the share price increasing, but what that does mean is that this fund is able to provide investors with a very high amount of passive income each month from those premiums. QYLD is one option, which currently has a yield of 11.73%. Alternatively, RYLD is very similar, only instead of buying stocks in the NASDAQ 100 index, it buys stocks in the Russell 2000. If you want downside protection when these indexes fall, NUSI is a great pick because it also sells put options on top of using covered calls. This means there will be a smaller dividend yield, but much greater amount of capital appreciation. This next investment type I'm going to talk about is a little more complex than the others on this list, and that would be MLPs, otherwise known as Master Limited Partnerships. These are a unique type of company, with nearly all MLPs being in the energy sector. While these companies can provide investors with substantially higher dividends, sometimes as high as 20%, I would suggest to the majority of investors out there that if you want to invest in MLPs, I would recommend doing so by buying shares of an MLP ETF, and I'll explain why. If you're in the United States and you buy shares of an MLP, at the end of the year you're going to receive something in the mail that you wouldn't get from a REIT, a BDC, or your typical dividend stock. You're going to get what's known as a Schedule K-1 tax form. This is because MLPs are taxed differently than your typical corporation. You know how when you buy shares of a company, you're considered to be a shareholder? Well, when you buy shares of an MLP, you're actually considered to be a partner of the business, which has different tax implications. K-1 tax forms are notoriously difficult and usually require the service of an accountant. What makes things more difficult is the fact that if the MLP operates in more than one state, you might actually be required to file state tax returns for every single state that the MLP conducts business in, which can no doubt increase the headache if you don't know what you're doing. I don't know how people outside the US are taxed when it comes to MLPs, so you'd have to do your own research. However, if you do invest in an MLP ETF, you will not have to deal with a K1. However, despite having to deal with a K1, I still get people who leave comments on my channel saying that they love MLPs. And the truth is, there are plenty of good reasons to invest in them. The first being that they offer massive dividends to investors, and then they also have lower volatility when compared to stocks and ETFs. They're liquid investments, and they do have certain tax advantages when it comes to estate planning in the United States. I've personally never held individual shares of an MLP, just to disclose that, but if you do want some MLP ETFs to check out for yourself, you might want to look at MLPX, which currently has a dividend yield of 6.73%, or AMZA, which pays dividends monthly, and it has a current dividend yield of 10.62%. If you do want to invest in an individual MLP, Icon Enterprises, ticker symbol IEP, is one example, which is an industrial conglomerate that currently has a dividend yield of 13.9%. Another one you might want to look into is USA Compression Partners, ticker symbol USAC, which is an oil and natural gas company that offers investors a dividend yield of 14.13%. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below, and also subscribe to the channel if you want to see more high dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that. Alright, thanks again guys, and I'll catch you next time. Take care.